The Peter Schiff Show.
Today's podcast is sponsored by NetSuite, the easy-to-use cloud-based business management software for every aspect of your business. Take advantage of NetSuite's special financing offer at netsuite.com/gold. Welcome, everyone. Well, gold this evening is trading at yet another all-time record high, although it's no higher, I think, than the record high that it set earlier in the day. We're trading just below 2,150. I don't think it actually traded that round number during the day, although I could be wrong. Within maybe 10 or 15 minutes of starting this live podcast, I noticed that gold was at 2,149. Now, in case you missed it, I recorded a special Schiff Gold video last night, to talk about the new record high in the price of gold. And the last record high was December of last year. So it took a few months for gold to make a new record high. I don't think it's going to take much longer to continuously break these records, because I do think that we're headed higher for the price of gold. I don't really expect to see a significant correction from here. I think we will get a bit of a correction, but I think it's going to start from a higher price. I think we're now kind of broken free from that low trading range. And I pointed out on the video from yesterday what is extremely unique about this. And I actually saw a chart. I don't have it to show here, but I did an interview earlier in the day, and somebody put up this graph of the inflows and outflows from GLD and compared that to the gold price. And it went to the rally in 2011, the rally in 2020, and the rally now. And the prior peaks, as the gold price was rising, there were big inflows into GLD, which would make sense, because one of the reasons that the gold price was going up is because the people were buying. Money was coming into GLD, and then GLD took that money and bought gold. But also, if you look at historically, the way retail investors tend to trade is they buy high and they sell low, which of course is the opposite of what you're supposed to do. But human psychology means that people get excited when prices are going up, and they expect that the trend will continue, so they want to hop on board. When prices start to fall, they get nervous that prices might keep falling, and so they want to get off. And this is what the pattern has been until now. This rally is the first rally to new highs where the public is not participating. In fact, for weeks, actually months, leading up to the new high, the public was getting out of gold. So they're missing the rally. I think that's a great contrarian indicator, and I think that's a sign that this rally has legs. Because normally the market peaks when you get a rush of buyers that come in, and now the market gets overbought, it gets saturated, and then there's a correction to kind of flush out the weaker longs. Well, with this rally, there are no weak longs to flush out because they already took themselves out. The other thing I pointed out, which I think is very encouraging for this rally, is that the buyers have very deep pockets. Because if the retail public has been getting out of gold, and there's no real sign that that exodus has continued, they may still be selling. But the central banks are the buyers, and they've got huge war chests of foreign currency reserves, plus they can print their own money and use that to buy gold. And I don't think the central banks are that price sensitive. I mean, sure, they don't want to run the price up. They want to buy it. But their goal is to have more gold. And their goal is not to sell any of this gold. So they're not trading the gold. The central banks who are buying this gold, if gold rallies $100, $200, they're not going to flip it. They're not day traders. They need the gold. These are long-term reserves for their currencies. The only time they'll sell this gold is if they have to. If their currencies are under attack and they need their gold to shore it up. So this gold is disappearing from the markets. It's not going to be out to trade. And any kind of dip that you're going to get is going to be bought by these central banks who want more. They would buy more right now, but they want to try to do it slowly because they don't want to push up the price of something that they need to buy. But certainly, if the market dips, they're going to buy that dip. But one element that I didn't really get into in yesterday's video, you should watch all of yesterday's video too if you didn't, because it's not an official numbered podcast, so you may have missed it. But one point that I didn't even make is that if the selling now, the supply, is coming from retail investors who are throwing in the towel, right? They've held on to gold for a long time and it hasn't gone anywhere and they're getting rid of it. And some of them are getting rid of it to gamble on the Bitcoin ETFs, right? That you got a brokerage account and now all of a sudden there's some Bitcoin ETF and everybody says Bitcoin's the new gold, Bitcoin's better than gold, gold stinks, right? You had Mark Cuban on a couple days ago saying he buys Bitcoin every day, any day over gold, right? It's better than gold, and people are being bombarded with this nonstop. Some people probably, bought into it and they made the trade. They sold their gold and sold their gold stocks. I pointed out, and I pointed out on this podcast, in fact, the last official podcast, the title was Bitcoin Mania Creates Golden Opportunity. The opportunity was to buy gold stocks. Newmont Mining made a 52-week low last week. Now it's 10% higher now than it was when some firm put a sell recommendation. I don't know, they put a hold, but that means sell. But the stocks are still very cheap, even with that rally, given that gold has also rallied considerably. And remember, the reason that the firm that downgraded Newmont, the reason they downgraded is because they said we don't see any upside in gold. Well, here we are at a new 52-week high with no resistance. I mean, why would you see no upside in a commodity that has no resistance? I mean, you're trading at all-time highs, but adjusted for inflation, we're not very high at all. And I pointed out that silver is half of its high. Why? Because the public is selling silver and the central banks aren't buying it. They're not there to take the other side of the trade. So silver is a steal. And the same thing with the mining stocks. The reason that Newmont and some other mining stocks got clobbered, but gold didn't, is because the central banks aren't buying the mining stocks. That's not what they want for reserves. They want the actual gold. And so that's what they're buying. But the point that I want to make now that I didn't make yesterday is that if the supply that the central banks are absorbing is coming from retail investors, where are these central banks going to source their gold when the retail investors stop selling? Because eventually they will. And in fact, eventually they'll start buying again, maybe at much higher prices, but they will start buying. And I think even more importantly, at some point, institutional money is going to come into the gold market because it's been AOL the whole rally. Pension funds, endowments, hedge funds, they're not buying gold. They will, but the point is, when all of these buyers who are on the sidelines join the foreign central banks and buy gold, who's going to sell them the gold? There's not a lot of gold being mined. I mean, there is gold, and I own these mining companies. And so Newmont Mining and Barrick Gold, they will sell gold to the central banks. They will sell gold to investors. But there's not enough of it because the gold industry has not been investing in building out new mines. They've been shutting mines down. They've been paying off debt. They've been consolidating and cutting costs and trying to stay ahead of rising mining costs. Because again, inflation has driven up the cost of mining gold much more than it's driven up the price of gold. So that's been bad for a lot of these gold miners. And also, there hasn't been a major discovery of gold in, I can't even remember when, 10 years, 20 years. I mean, normally every few years, somebody discovers a bunch of gold, but no one's discovered any. So you have a situation where the market is undersupplied and it's about to run into a huge increase in demand. And what does that tell you? That means that the price of gold has a long way to go to catch up to clear that market. Gold is very undervalued right now, and it has been for some time. And that is the opportunity to buy it before it's repriced to a realistic valuation, which is many times higher than it is now. And then once gold gets to a fair value, then I expect it to appreciate gradually over time as the dollar and other fiat currencies continue to depreciate. But the real opportunity for an investor like myself or whoever is listening is in these mining stocks because there's a complete dichotomy here. I mean, these stocks are not priced for the reality of where gold is, let alone where it's going. And so they're still really cheap, but I'm still waiting for the day when these stocks go up 10, 20% in one day. I think that day is coming, and it may be coming soon. But before it does, that's a better time to put more money to work. I mean, I put a lot of my own dry powder to work last week, and in fact, I depleted the cash I had because I was so excited personally about the buying opportunity that I bought what I could. I kind of went all in with what I had left. You know, of course, I'm earning more money, and so I'm going to have to figure out where to invest that. But what I had been saving, I put to work because I love to buy when they're downgrading. When somebody downgrades Newmont and says sell, I'm like, okay, great. That means buy as far as I'm concerned. But the markets, the investors just don't understand this. But looking what's going on in the gold market, this is not an accident that gold prices are making new highs. And in fact, this is a warning sign. It should be a warning sign to the Federal Reserve that monetary policy is too loose. That's why gold is going up. But not only is Powell not going to heed this warning and tighten policy, he's going to ease. And I'm going to get into that right after this commercial. But Powell was testifying today at the House, and tomorrow he makes his way over to the Senate. But he was testifying, and he said that interest rates have peaked, which we know, and that cuts are coming, and that they're going to be substantial. He just didn't say when they're going to start, but he's going to ease policy when gold is already telling you that policy is too loose right now, and it needs to be tightened. So what is Powell doing? He is throwing gasoline on an inflation fire that he lit. Anyway, we're going to talk more about that on the other side of this commercial break, so stick around. We'll be right back.
Your business was humming, but now you're falling behind. Teams buried in manual work, taking forever to close the books. Getting one source of truth is like pulling teeth. If this is you, you should know these three numbers: 37,000, 25, and 1. 37,000. That's the number of businesses which have already upgraded to NetSuite by Oracle. NetSuite is the #1 cloud financial system, streamlining accounting, financial management, inventory, HR, and more. 25. NetSuite turns 25 this year. That's 25 years of helping businesses do more with less, close their books in days, not weeks, and drive down costs. And 1, because your business is one of a kind. So you get customized solutions for all your KPIs, key performance indicators, in one efficient system with one source of truth. Manage risk, get reliable forecasts, and improve margins. Everything you need, and it's all in one place. Right now, you can download NetSuite's popular KPI checklist designed to give you constantly excellent performance absolutely free at netsuite.com/gold. That's netsuite.com/gold to get your own KPI checklist. netsuite.com/gold.
All right, so I want to talk about the Powell's semi-annual testimony today at the House. And, before he delivered his prepared remarks and took questions from the congressman, a couple of them spoke. The chairman of the committee, the ranking minority member, and that's Maxine Waters. And I want to point out something that she said, because in her little talk, she brought up housing. And she said that housing is a main driver of inflation, that rising housing costs are the reason for inflation, a main driver. And, of course, that's not true. Housing isn't driving anything. Housing's just going along for the ride. The driver is Maxine Waters, right? And her buddies in Congress. They're driving the inflation bus, not housing. Housing's just riding in the bus along with everything else. The driver of inflation is deficit spending and then the money that the Federal Reserve prints to monetize that debt. That is what drives inflation. Everything else is just dragged along. So Maxine Waters has got it wrong. Instead of chastising Powell because somehow he's not paying attention to housing as if, there's something he could do, she should be looking in the mirror. She's the reason that the price of housing and rents and everything else are going up. But also, to make matters worse, there's a lot of regulations coming out of government, and not all of it from the federal government, a lot of it from state and local governments, that unnecessarily makes housing more expensive. Whether it's making rents higher than they should be, or maintenance costs, or taxes, or insurance. But a lot of stuff costs more because government regulation is interfering in the market. So the reason that people are struggling with housing prices is government-created inflation and government regulation. And a lot of it is coming from the House, where Maxine Waters has been a member for I don't know how long, but for quite some time. But anyway, so when Powell speaks, he again talks about how good the economy is. The economy is great. The labor market is strong. We've avoided recession. And in fact, all the Democrats, of course, use their time as an opportunity to talk about how great the economy is and give the credit to Biden and Powell. But then the Republicans come in and they try to point out that the economy isn't good and we have a lot of inflation, and they blame that on Biden. But they overlook the fact that when Trump was in charge, they were running deficit spending too. A lot of the all the COVID stimulus started with Trump. It's just that when Biden came into town, he expanded on what Trump had already done. But it's not like the Republicans have clean hands here. And so it makes their criticism, disingenuous. And, some people might accept it, but for other people, it's harder. That's why I like being consistent. So I have credibility when I say something. I'm not just being a political opportunist and just trying to blame the other side of the aisle. I look at both sides as complicit, even though clearly, what Biden is doing now is even worse. But, if Trump wins, and of course, he now wrapped up the nomination, I guess I can, just digress a bit. But yesterday was Super Tuesday. Not very controversial. Normally, these Super Tuesdays, are more exciting because there's more of a contest going on. But that was it. I mean, Trump basically swept Super Tuesday, I think, except for Vermont, where he lost by a very tight margin. But remember, Vermont is a very left-wing state. I mean, that's where Bernie Sanders is hailing from. And so the fact that he lost a close one in Vermont really doesn't mean very much. But anyway, Nikki Haley, who won Vermont, finally stepped aside. And so now it's just Trump. Now she hasn't endorsed Trump, but she's moving aside. So the nomination is completely locked up. Not that it wasn't already locked up, but now kind of officially it's locked up. But, there's a lot of optimism that, if Trump goes back to office, the inflation problem is going to go away. Well, nothing that Trump is talking about doing is going to solve the problem. And if he presides over a second term the way he presided over the first term, it's just going to get a lot worse because it's just more deficit spending. Right? That's what he did before. Maybe he'll change. We'll see. But what Powell was saying about inflation at the beginning was incorrect, because he is claiming that inflation is pretty much down, and he just wants to make sure it stays down, right? It's like we've solved the problem, but we don't want to prematurely claim victory. We want to just wait and make sure that it's dead. We think we killed it. We just want to make sure before we start cutting rates. But we're going to cut rates. That was what he said. And in fact, he didn't just say we're going to cut rates. He said that rates are going to be substantially lower. In fact, in the Q&A, Powell said that he expects the economy to keep growing, so no recession. He expects the labor market to stay strong, meaning low unemployment. Not that we even have a strong labor market to begin with, so you can't stay strong if you're weak. But everybody claims it's strong, including Powell. So he expects it to stay strong, and he expects inflation to come down. And because those three good things are going to happen, he said interest rates will be substantially lower than they are right now. Now, the question is why? Why should interest rates be substantially lower? They're not that high. They're about 5.25%. A lot of people try to compare the economy today and the markets today to the 1990s. Of course, they forget that the 1990s didn't end very well with the 2000 crash, but they're still comparing everything to the 1990s. Well, the lowest the discount rate got during the 1990s was 3%. The high was 7%. The average was about where we are right now. And the only reason rates went down to 3% was the early 1990s, because we had a recession. Now, if Powell doesn't expect a recession, he expects the economy to keep growing, why should interest rates be substantially lower than they are right now? Because, what is substantially? If he's not talking about 4%. If he says, hey, rates are going to go from 5 to 4, that's not that substantial. Substantial probably means 3 or lower, I would say, would be how I would interpret a substantial reduction. You're like 40% or more, right? Substantial. But why should that happen? If the economy is as good as he says, if the labor market is as strong as he says, why would there be a substantial reduction in interest rates? Remember, the only reason that we slashed interest rates to a really low level was we had a financial crisis in 2008, and then we had the COVID crisis in 2020. Those were emergency measures, temporary measures designed to get us out of a big hole. Well, if we're not in a hole anymore, if the economy is great, why is Powell even talking about cutting rates? And even if Powell was right about inflation coming down, which he's not, if it did come down and then we substantially reduced rates, it would go right back up again. And that is what gold is telling you. If gold is telling you that rates are too low, how do you lower them in the face of that? Those are the mistakes that were made in the 1970s before Paul Volcker came into office and finally did the right thing. We're still doing the wrong thing under Powell, and what he is indicating he's going to do is extremely dangerous. And now the dollar was down, a decent amount today, I think 0.5%, still, well north of 100, around 103, but the dollar again, to me, looks like it's rolling over. Because where are the central banks getting all the money to buy this gold? It's dollars. They're using their dollars to pay for the gold. The whole purpose of buying gold is to get out of dollars. That's what they want to do. But you can't get out of dollars without getting into something else. And so why get into euros? Why get into yen? Why take that chance? Buy gold. That's your safest bet. That's the only monetary asset that's not somebody else's liability. That's the only asset that you can't get sanctioned as long as you have the gold, in your own custody, right? You're not leaving it at the Fed or something. You take delivery of the gold, you keep it within your own sovereign territory. I mean, no one can take it unless they physically invade you, right, and take your gold, right? And so this is what people are trying to do, and the Fed is completely ignoring it. There's a couple of interesting points that were made during the Q&A that I wanted to bring up. One of the congressmen actually said that he thinks the Fed should have a higher inflation target. Right? This was a Democratic congressman, Brad Sherman, California guy. And he says, look, why 2%? As if higher inflation would allow greater economic growth. These guys think that somehow this inflation fight is hurting the poor, and that if the Fed only allowed more inflation, then we can have a stronger economy. No, it's inflation that hurts the poor the most. If the Fed actually was going to reduce inflation, it's the poor that stood the most to gain. The problem is the Fed's not going to do that. But this guy, when he said that the Fed should just raise the target, he said that he did some research and he discovered the origin of the 2%. And he said it came from Auckland. And he said, well, why should we care what, a bunch of Kiwis came up with this number, out of a hat? They just grabbed it. So why is that the holy grail, right? Now, the problem is he did some research. He didn't do enough research. He is correct. The 2% number did come from Auckland, New Zealand. But it was never a target. That is the difference. It wasn't like some economist in New Zealand decided that 2% was, the sweet spot for inflation and that we needed 2%. No. What they did in New Zealand is they said 2% is as high as we're going to allow inflation to be. If inflation gets up to 2%, that's a problem. And so do something about it. Make sure inflation stays below 2%. So 2% was the ceiling. It was not a target. It was not a goal. It was a limiting ceiling. It meant don't let inflation get above 2%. That didn't mean that if it was 1%, you had to try to get the rate up. No. If it was 1%, well, you could leave well enough alone because you're below 2. In fact, the further below 2 you were, the better. No idiot would have said that if inflation is 0.5%, we need to increase it to get it up to 2. They weren't that dumb in New Zealand, but they are that dumb here and in Europe because they took that 2% ceiling. Initially, they made it a target, and then they made it a floor, right? We don't want inflation going below 2%, right? So it's now a floor, although it's a floor we're never going to reach, right? We're going up. There was another question, though, and I was excited because I thought the guy was going to make the point that I've been hoping somebody would make, but he didn't take it that far. He brought up the fact that a couple of years ago, when inflation first got up around 2%, and Powell said, we're going to let it run hot above 2%. We're going to allow it to be above 2%. And he brought that up. But what he didn't bring up, and I was hoping he was going to bring this up, what he forgot to mention was that when the Fed did that, they also introduced this new mandate of average inflation targeting. The Fed decided to redefine its made-up 2% mandate to be an average inflation rate of 2%. And that's what allowed the Fed to let inflation go above 2% because it changed its mandate that it never really had but made up from 2% inflation each year to inflation that averages 2% over time. And then Powell said, look, we've had many, many years where inflation was below 2%. And that means we need to have a few years where it's above 2% so that we can get the average up to 2%, right? Which, of course, is BS. You don't have to make up for having low inflation in the past by having even higher inflation in the future. But I wanted him to ask Powell, okay, well, are you still believing in that concept of average inflation? Because if you do, and you want to bring the average rate of inflation back down to 2%, then we need lower than 2%. Why stop at 2%? If you still believe in inflation averaging, we need 1%. We need 0.5%. In fact, maybe we need some years where prices go down because we have some very, very high rates that we need to average down. I want to see how Powell handles that, right? Because obviously he doesn't believe in inflation averaging anymore. So it's just very selective. Only when inflation is low do we need to average it up. But if inflation is high, apparently there's never a need to average it back down, right? What kind of heads I win, tails you lose analysis of that? The whole thing, it was just Powell didn't want to raise rates. And so they made it up because they were afraid of raising rates because of how levered up the economy is. Well, if they were afraid of raising rates back then, imagine how scared they are now. That's why they stopped hiking. That's why the Fed is ignoring these signals. That's why the Fed is not raising rates more, which is what they should do. Because as I pointed out on this podcast, credit card debt is at a record high. Household debt is a record high. Government spending a record high. The rate hikes have done nothing. Too little, too late. The Fed has not bent the inflation curve at all. It doesn't matter that the numbers have come down from 9 to 3. It's not because of those rate hikes. And the numbers are going to go up. The only way the rate hikes affected the inflation rate is that the anticipation of rate hikes brought down commodity prices. But they're going back up. Oil got back almost to $80 again today, 79 and change. Look at the stock market, too. I mean, one of the ways that higher rates has typically brought down inflation was a reverse wealth effect. Higher rates bring down stock prices. They bring down housing prices. That doesn't happen. Housing prices are record highs. Stock prices are record highs. And the Fed is done hiking. I mean, normally when the Fed is finished hiking, asset prices have come down, right? They start to go up when the Fed starts to cut. But they never went down when the Fed hiked. So how are you going to ignite an even bigger asset bubble by cutting rates when prices never even went down? So the rate hikes have done nothing to put that inflation genie back in the bottle. And Powell wants to keep taking credit for it. Meanwhile, they talked about how strong the economy is, and they ignored all the weak economic data that's been coming out recently, as if it doesn't exist. In fact, we got more data this week, and we're getting, of course, the big number on Friday. We get the non-farm payroll number. I've decided now that the football season has come to an end, and people may actually watch a Sunday podcast, I'm going to do my podcast where I go over the non-farm payroll number, as well as Biden's State of the Union address, which will be on Thursday. That's going to be something. And day 2 of Powell's testimony, which is tomorrow. I'm going to go over all of that on Sunday, on a live podcast on Sunday night. But we got more economic data this week. Most of it was lower than expected, especially factory orders, which tanked. January factory orders down 3.6%. I mean, they were expecting down 3%, so they were still expecting a bad number. They got an even worse number. But they revised December of last year from up 0.2 to minus 0.3. But the minus 3.6, that was the weakest factory orders since the economy was shut down during COVID. Well, if the economy is so strong, why are factory orders as weak as they were when the economy wasn't even open? It was shut down. And again, remember, the two ways that higher interest rates bring down inflation is, one, they bring down spending and borrowing, but they increase savings, which increases capital investment in production. So factory, we should be producing more, but we're in a manufacturing recession. So prices are going up, right? We have to rely more and more on imports. But we also got weak numbers from the service sector, which is, the bigger part of the economy, ISM services. That was supposed to come in at 53, which would have been a decline from the prior month. This is February now. But we dropped all the way down to 52.6. I mean, not that much lower than 53, but compare it to the 53.4 for the prior month. That is a negative trajectory. And the strongest part about the weak ISM number was the prices paid. So prices are going up, and they're about to go up a lot more. And nobody seems to recognize that. Now, we got the ADP number, too, the jobs number today, this morning, the private sector payroll number. And it was also weaker than expected. I mean, not a lot weaker. They were looking for 150,000 jobs. We got 140, but it wasn't a beat, and it was a miss. There was a slight upward revision to the prior number, but that was a weak number. It was 107,000, and it was up to 111. But the markets really pay attention to the government number, which comes out on Friday. But all these numbers you could take with a grain of salt, because I expect all of them to be revised down. My guess is a lot of the big revisions are going to be coming out after the election. So you don't know about them when you cast your vote in November, right? You find out that you were lied to all those years, all those months rather, and you were actually in a recession the whole time. They were taking credit for, not even landing, let alone having a soft one. And it'll turn out that we actually were in a recession the entire time. Again, remember, that's what happened with the Great Recession in 2008. It started in December of 2007, but the government didn't acknowledge it until December of 2008. So an entire year was revised down, and the government said, hey, all the numbers we've been giving you for the last year, they were all wrong. We were telling you how good the economy was, what was actually in a recession the entire time, right? That's what I was saying. Back then, I was talking about it, and then it was confirmed. So I think the same thing is going to happen now. Another point I wanted to make too, one of the congressmen pointed out insurance rates were going up. And this is something that, I've been talking about on this podcast. I mean, specifically insurance, whether it's auto insurance, homeowners insurance, health insurance. I mean, insurance rates have just been on fire. And so a congressman points this out. And Powell actually admitted, he said, oh yeah, insurance costs have gone up a lot. I mean, he said a lot. I mean, that's like a big thing, right? Yes, they've gone up a lot because of inflation. Again, they acted like, oh, we have inflation because these insurance companies, these greedy insurance companies, are raising their premiums. No, they're raising their premiums in response to inflation. They're not causing it. They are reacting to it. Biden is stepping up the campaign. I was on Newsmax earlier this evening. I didn't even realize this, but they have this campaign out now using the Cookie Monster from Sesame Street, complaining about shrinkflation and greedy companies jacking up the price of his cookies and making smaller cookies, right? You have a full court press now on the part of the government to blame the private sector for inflation. That is precisely why they lie to the public about the definition. That's why they've told everybody that inflation is rising prices. Because if the government properly defined inflation as an expansion of the money supply, then they can't blame greedy corporations for inflation because they can't expand the money supply. It would be obvious. Once you know what inflation is, it's obvious the source. But if you believe inflation is prices going up, well, then it's easy to blame the people who raise the prices, the corporations. But they're not raising prices because they want to. They're raising prices because they have to. Why do they have to? Because their costs went up, which are their prices. And why did those costs go up? Because the government created inflation. Look, businessmen are greedy, that's true, but they're always trying to lower their prices. Everything a businessman does, his goal is lowering prices. What can I do to lower my prices? How can I cut my costs so that I can offer a lower price? Why do businesses want to offer lower prices? So they can take the business away from their competitors. Businessmen know that their customers are shopping around. They want the best deal. They want the lowest price. So if I want to win more business, I got to be cheaper than my competitors. So I want to lower my prices. I can only do that if I can figure out how to lower my costs. Got to be more efficient. Now, if I can lower my prices, not only can I get more business away from my competitors, but I can do more volume. Every businessman knows if I can lower my price, I can sell more. I can do higher volume, I can make more money. I'll sell more widgets and I'll make more money. Even if the price is lower, as long as I maintain my margins, I make more money. So businesses don't want to gouge the customer. They want to please the customer. They want a happy customer. It's the government that gouges the customers because the government doesn't give a damn. The businesses care about the customers because they have to voluntarily win their business, right? And they have something to lose. If my customer leaves me and buys from somebody else, I'm out of money. I lose. So I want to keep my customer. Even if I don't like him, I like his money. I like the fact that he's spending it at my business. That's why there's an old saying, the customer's always right, right? I mean, why is that? Because he's the customer. He's in the driver's seat, right? Even if your customer is wrong, he's right. Anybody that has a small business knows that, right? That's capitalism. That's why it's great to be a customer in a capitalist system because you're always right, right? The businesses answer to you because you have the final say whether you patronize them or not. The government doesn't give a damn about you because you're stuck. They've got you by force. They've got the guns, right? You have to do what they say. So, no, you're always wrong in the eye of the government, right? You're an idiot. They got to tell you what to do, right? So when the government is trying to blame the businesses are every much a victim of inflation as their customers. In fact, they're doing everything they can. In fact, I pointed this out early on when inflation was just getting started and the government was saying it's transitory. Businesses were avoiding price hikes. They were eating the rising costs because they were hoping it was transitory and they didn't want to piss off their customers. And they figured, well, look, it's just a few months. We'll wait it out. We'll eat these higher costs for now and they'll come down and it'll be great. I was always saying that eventually there was going to be big price hikes down the road when the businesses throw in the towel on transitory and realize that it's permanent and now they have to hike prices, to catch up. And all of that happened. So we're getting this big press now, by Biden to try to convince everybody that it's greedy businesses that are causing inflation, and that's why you should vote Biden and Democrats because they're going to force those businesses. We're going to have new commissions. We're going to have studies, and we're going to go after those bad guys. And maybe we'll pass new laws and new regulations to stop businesses from raising prices. And that is going to happen. Price controls are coming. I've been warning about those for a long time. That is the next step. First, you blame the businesses, then you vilify the businesses, and then you make it illegal for those greedy bastards to gouge you by raising prices. And then the problem gets much worse. Now, there's nothing to buy. Now there's shortages. Now, if you want to buy something, it's on the black market. That's when it really costs money, when it's illegal. Because the guy who's selling you something on the black market, he risks going to jail if he gets caught. So you got to build that into the price. And now you're really, getting screwed. But it's the government that is responsible for the problem, not the free market or even the guy that's working in the black market. Because if you go to the black market to buy something, that's your only way of getting it. So the guy is actually doing you a favor by breaking the law and selling you something that you need that otherwise you wouldn't even be able to get it because the government made it illegal for somebody to legally sell you that product. And so the only way you can get it was on the black market. Anyway, that's it for today. Again, I got another podcast coming up on Sunday. In the meantime, don't wait on your gold. I think we're just going up from here. We had a long base that we built around 2000. I think it's just a slow climb until it becomes a steeper climb. So I think the sooner you buy, the cheaper it's going to be. With silver, they're giving it away. Again, central banks aren't buying silver, so you should. because it's cheap. If they were buying it, it would be a lot more expensive right now, just like gold is. But eventually, when the public starts to buy gold, they'll buy silver too. And the good thing about buying silver now is the premiums are still low, because if you wait for silver to be $30 or $40 to buy it, not only is it going to be much more expensive, but the premiums on the bars, the coins, are going to be much higher. That's what happens with silver. All of a sudden, everybody wants to buy it, and there's no inventory. And so now the premiums go up in addition to the price. So right now, it's still the lull before the storm. You can still buy silver at a low price with a low premium. So call up the guys over at Schiff Gold and get some silver. It's Schiff Gold, but we also can get you some silver. But again, the best buys out there are the mining stocks. I actually read an interview. The CEO of Newmont Mining said that his stock, in his opinion, was a once-in-a-lifetime buying opportunity. He's a little biased, because he works at the company. But he works at the company. He ought to know what a good value it is. And CEOs normally don't say that. They're worried about getting sued. But in this case, I think he's pretty sure that he's right, and I agree with him. He is right, and it applies to a lot of other gold mining stocks. So remember, my gold fund, the Euro Pacific Gold Fund, EPIVX, is the no-load ticker symbol. Don't pay the load if you're going to buy it in a discount broker and do it yourself. But if you're going to work with one of my advisors at Euro Pacific Capital, Alliance Global Partners, if you're going to go through Euro Pacific Asset Management, then you're working with a broker, you can pay the load. But we also have a wrap program where we waive all the loads, and I'll manage your portfolio of my funds. But we have separately managed accounts, which of course aren't even in a fund. Adrian Day, who manages the mutual fund, he manages the separately managed accounts. You can set one of those up at Euro Pacific Asset Management. Even though we've seen maybe a 10% bounce in this sector, 5-10% in the last week, you ain't seen nothing yet. These stocks are coming off of multi-year lows, and they've already priced a much lower gold price in. Not what we got now, let alone where we're going. But there's massive leverage in these companies when gold catches up to the cost of mining, and all of a sudden, a lot of companies, I mentioned earlier, we're going to have to get gold out of the ground to satisfy this demand. But the only way it's going to come out of the ground is if the prices go way up. Because right now, a lot of the gold that mining companies have, it's too expensive to extract it. If they can only sell it for $2,100 an ounce, $2,200 an ounce, they ain't digging it up. And so the only way that gold is going to become usable supply is if the price moves much higher. And it's going to move much higher. And that's why you want to get into these stocks before it does. Anyway, take care, and don't forget, give me a thumbs up and comment on the video if you liked it, and I'll see you on Sunday night.